The Bank of England takes a dovish turn, but is inflation really beaten? The Bank of England stopped short of cutting interest rates, but only just. The surprisingly close vote and forecasts showing inflation falling below target have pushed markets to price in a possible move as soon as March. The message from Threadneedle Street sounded dovish, but is it justified? Well, let's ask James Smith, developed markets economist at ING. So James, Governor Bailey said disinflation is on track, but UK inflation just printed its highest reading in 5 months. So policymakers underestimating how sticky inflation really is?
No, I don't think so, actually. Inflation's going to come down quite substantially over the next few months. We think inflation's going to get from 3.4% in December to 1.8 in April. And a lot of that is actually already baked in. Some of it, you could argue, is down to energy prices and maybe stuff the bank's less bothered about. But actually, Bank of England hawks have been quite worried about the fact that headline inflation has been higher than 3%. They were getting a little bit nervous. We could see something similar to 2 or 3 years ago where inflation spiked and stayed higher for longer. Those risks, I think, are receding, and I think that's why the bank is getting closer to another rate cut.
Well, let's talk about the trade-off. And Bailey rejected the idea that higher unemployment is a price worth paying to bring inflation down. But doesn't taming inflation almost inevitably mean some softening in the labour market?
I think so, and that's exactly what we're seeing. Unemployment has risen. Private sector payroll numbers are down about 1% through 2025, and that pace actually picked up towards the end of last year, hiring surveys a week. And importantly, that's finally having a big impact on wage growth. I think that had been the missing piece of the puzzle for quite a long time. The Bank of England, concerned that wage growth was staying elevated despite what we were seeing in the jobs market. But that is changing. Private sector wage growth was 6% at the start of last year. It's about 3.5% now, could be 3% very soon. And importantly, the bank is telling us that's consistent with a 2% inflation target.
Well, the bank's latest forecast paints a noticeably weaker growth outlook than in November. Is that deterioration in growth now playing a bigger role in policy decisions than the inflation risks?
No, I think inflation's still the dominant story. The news on growth has been a bit mixed recently. We've had some better PMIs, but I think the underlying story the bank thinks is still fairly weak. We think 2026 economic growth is going to be a little bit weaker than 2025, but not significantly so. And I think it comes down to the jobs market. We've got 2 sets of jobs reports between now and the March meeting. If recent trends continue, I think we're on track for a March rate cut.
Well, Billy did note that he was comfortable with markets pricing around a 50% chance of a cut in March. Do you see that as likely as well? But how quickly do you see bank easing policy once cuts resume?
Yeah, so we expect a rate cut in March. That was our expectation ahead of this week's meeting. And I think what we saw on Thursday has only reinforced that view. And as I mentioned, headline inflation is coming lower. As we go into the spring, we should see more wage disinflation. The services inflation number should get better. And I think that should unlock another rate cut in June. We could even get more after that, but for now, we're looking for 2 more cuts from here.
So finally, James, one risk that the bank can't easily factor is political instability. So with pressure mounting on Prime Minister Keir Starmer, does the uncertainty tilt the balance of risks for the pound to the downside?
I think so, yes. We've long argued that politics is the biggest risk for UK markets in 2026, and I think that's exactly what's playing out. Increasingly, it feels like it's a question of when, not if. There's a change of leadership. Let's see. But I think if that's to happen, were we to see a change in Chancellor, that's something markets are looking at. And we've seen before that, concerns about rising borrowing under a replacement for Chancellor Rachel Reeves has pushed up gilt yields. So it's something we're watching quite closely. And as you say, potentially is sort of downside for the pound, could push euro sterling higher up towards 90 over the coming months.
That was James Smith from ING. Don't forget, you can watch more videos on Reuters.com.